What's going on, everybody? It's Cash Flow Nexus, the channel of faith, trading, and wealth, giving you the latest and greatest updates on how to trade. Those that are new to trading, this is going to be a great video for you to understand how to read candlesticks and reading the market. A lot of people have concerns and don't know where to start when it comes to reading the charts, but it always starts off with the candles and understanding the basics. So this is going to be the greatest guide for beginners in learning how to read the markets with candlesticks. All right, so stay tuned, take some notes and get prepared on learning how to read some charts, and also use some of these strategies that I'm going to be showing you with the charts. All right, because it's very effective, and those that know my style that have been on this channel know that I trade the Japanese style, which is Ichimoku Kinko. If you are interested in learning how to trade, Ichimoku as well, stay tuned to this channel, like and subscribe, and definitely enjoy the content as it comes. All right. That being said, let's jump right into this. So, price action, high probability trading is all about understanding how to read the anatomy of the candles. So we're gonna go through, this is going to be the breakdown of this course. Is going to be 1, candlestick anatomy, 2, types of candlestick formations that I personally use in the markets, 3, market structure, and 4, identifying potential reversals. Going back to 2, types of candlestick formations, I'm not going to give every single type of candlestick formations. I'm going to give the formations that I personally use that are effective. It's all about simplifying your trading. Making your trading harder is not wise, so definitely focus on simplifying your trading and making your trading easy. All right, so I will be going over some candlesticks that I personally trade. All right, so starting off with the candlestick, let's take a closer look. All right, as you see the candlestick anatomy here, we have a bullish candle on the left, we have a bearish candle on the right. As you see, the close of the bullish candle is going to be on top, as the open is on the bottom. And you see that little wick on the bottom. You see it's the lower shadow, or you could call it the low. And as you see, the higher upper shadow is the high. And you see on the bearish candle, the open of a bearish candle is at the top, while the bearish candle closes at the bottom in the lower. And it's the same as the bullish candle. The low of the wick is the low, and the high of the wick is the high. Candlestick charting. Candlesticks are the ABCs, the 1, 2, 3s in the do re mi language, and the code of the market. Candlesticks allows us to quick read on the changes in supply and demand by analyzing price movements of the asset. Using candlesticks, a trader is able to identify and confirm evidence of a possible trend reversal early on. Candlesticks draw an inductive as opposed to deductive view on the markets. All right, so let's look here. So here we have a spinning top. This is what a spinning top looks like. Candlesticks are like I said, candlesticks are the ABCs, the 1, 2, 3s in the do re mi language of the code of the market. And the spinning top candlestick formation is just a regular candle. It looks pretty much like this. As you see these quite a bit on the market. What the spinning top represents is represents market indecision or consolidation in the market, in the short-term equilibrium of things. The color of the body of the candle along with the size of the shadow is not important, so don't worry about what this looks like. It doesn't matter what color it is. You could also change your color scheme. Me personally, I use blue and purple for my color scheme, but in this instance it's a purple candle, and the color of the candle does not matter. It's all about understanding what that formation and what the candle is telling you. All right. Next, here we take a closer look. We see a tweezer top. These usually happen at a level of resistance. All right. This is a moderately reliable bearish reversal candlestick formation consisting of 2 candlesticks that are seen near the end of a bullish trending market. The first candlestick in the pattern is a rising bull candlestick, while the second candlestick is a declining bear candlestick. This pattern forms at the area of resistance, a high point of a weakening uptrend, which is suggesting the market may start to move lower. Any two candlesticks can be a tweezer top as long as the second candle open and close remains inside of the previous candlestick, open and close. All right. Now there's always the opposite to that. This is a tweezer bottom, which happens at support. All right. It's pretty much the exact opposite of a tweezer top. This pattern follows the same rules as a tweezer top, but in reverse. It is a bullish reversal candle formation consisting of two candlesticks that are seen near the end of a bearish market. It consists of two candles, the first being a declining bear candlestick, while the second candlestick is a bullish candle. All right. This pattern forms at the area of support of a weakening downtrend, which suggests the market may start to move higher. All right. So here's one of my favorite candlesticks, and we take a closer look here. Hope everything is making sense to you so far. This is the long-legged doji. This candlestick formation shows that price traded far from its opening and closing points, only to return back with no momentum or decision by either bulls or bears. In a strong trending market to the upside or the downside, this candlestick, when formed, can suggest that the market can possibly reverse the trend or simply stay in the short-term indecision. Stay in some short-term indecision. So understanding this candlestick, this could be either a bullish or a bearish reversal, depending on where you see it at, or support or resistance. Or it could simply mean that the market's going to, stay in an indecision for short term. So always pay attention to this candlestick. It's very helpful when looking at the chart. It definitely will save you from holding a trade, and maybe help you to close a trade before a potential reversal in the market. All right. Here, the Gravestone Doji. All right. This usually happens at resistance. All right. As we take a closer look at this candlestick shows price action that opened and closed at the near the bottom of its current range, giving the bears an upper hand for the session, and is considered very bearish at the top of a bull run. This is a very strong bearish reversal candle, suggesting bulls are exhausted. This candlestick adds more probability of going in your favor for a short. The longer the upper shadow / wick, the higher the probability for a trend reversal. Now note this, not all candlestick formations, follow the rules of the market. It's just suggesting that the probability is going to be higher in your favor. Never say that just because you see a candlestick formation, it does not always say that the market's going to go in that direction. The probability of it happening is a little bit higher. All right. Now here we have the Dragonfly Doji. This single candlestick is the opposite of a Gravestone Doji. This candle suggests strong bullish reversal, which forms at the end of a downtrend. Keep an eye out for these candlestick formations at a major demand zone or support levels, where buyers are usually strong. All right. As we see here, here's another bullish candle formation. This candlestick is a solo candle formation that's considered a bullish reversal pattern, forming at the bottom of a downtrend at support. The shadow at the bottom shows the rejection of lower prices by buyers. The shadow of the candlestick should be 2 or 3 times the height of the body. All right. So this is giving you more insight to how to identify the candle. These candles could be either color, as long as it forms the hammer formation. You have a hammer candlestick. All right. Now we have the opposite of a hammer, which is called the shooting star. Another solo candlestick formation, which is considered a bearish reversal candle. These form at the top of an uptrend and often get mistaken for a Gravestone Doji. Pattern indicates market is rejecting higher prices and reflects potential selling interest at a supply zone. All right. This is actually one of my favorite formations to trade. I trade these quite often. This is called the dark cloud cover. This pattern is important for traders to take notice of, showing a possible signal of reversal to the downside. It is not as strong as the signal as a bearish engulfing pattern. Nonetheless, a dark cloud cover is important to note as a potential bearish indicator, especially if it forms on a higher time frame. All right, notice that. Such as a daily chart or a weekly chart. On a lower time frame, it may not hold as much strength as one seen on a higher chart. This candlestick can be recognized by the current candlestick closing bearish at least 50 to 60% of the previous candle. So as you see here, the candle has to close between 50 to 60% or more of the previous candle, as you see on the diagram that we see here, right? The opposite of that is the piercing line formation. All right, a piercing line pattern is a two candlestick price pattern that marks a potential short-term reversal from a downtrend to an uptrend. The pattern includes the first candle opening near the high and closing near the low with an average or larger size trading range. After the first candle, where the second candle begins trading, open at the low and closing 50 to 60% of the previous candle. So once again, the close should be a candle that covers at least half of the upward length of the previous candlestick body, as you see here in this diagram to the left. Now, this is one that I like to trade a lot, the bullish engulfing candle. A bullish engulfing candle completely engulfs the previous candle's range high plus low. A bullish engulfing pattern is a hint that a market may have formed its bottom. This bullish engulfing pattern is also a powerful buy signal like its counterpart, but it's a bullish sign. So its counterpart is going to be the bearish engulfing. A bearish engulfing candle completely engulfs the previous candle's range, high to low. A bearish engulfing pattern is a hint that a market may have formed its top. The bearish engulfing pattern is a powerful sell signal and more reliable than its lookalike dark cloud cover. All right. Now these two formations, these are very important to understand this formation. This is a 3 candlestick pattern formation. We got the evening star and the morning star formation. The evening star is they usually form at resistance, while the morning star usually forms at support. The evening star pattern is a 3-bar candlestick pattern that usually occurs at the top market tops, and morning star pattern is a 3-star candlestick pattern that occurs at market bottoms. The evening star is a bearish reversal pattern, while the morning star is a bullish reversal pattern. All right, check that. Now, going to number 3, market structure. This is very important to understand market structure. Market structure refers to price structure and the way market moves and how it interacts with each other to form cycles. Shows us the foundational direction of the market. Best way to find market structure is the use of fractals. Market trends start and end with a fractal. There are 3 kinds of market structures to take note of: bull trends, bear trends, and sideways trends. Sideways markets consolidation. All right. The bull market is depicted by higher highs and lower lows. The trend will continue in that direction until a lower low is printed by the asset price. The trend begins to show signs of weakness when it fails to break the higher high. The bear trend is price action of lower lows and lower highs. The bear trend will continue to fall as long as lower highs continue to print. When a higher high comes into price, the trend will end. The sign that the trend may be reversing is price beginning to print higher lows or equal lows. The sideways trend is a trend that has an equal high, that has equal highs and equal lows. Price trends in a range during that price of the market and is in consolidation. Markets can move in a period of consolidation for a long time. This trend is broken if the price breaks out from the top or bottom of the range. This could be the beginning of one of the first two trends. So for a sideways trending market, for it to be bullish, it has to break the high. For it to be bearish, it has to break the low. So it could be the start of either real trending market. All right. So identifying potential reversals. We're going to take a look at the live charts, and we're going to look at how to use these candlestick formations. And I'm going to show you how to use it with Ichimoku and without Ichimoku, looking at naked charts. All right. So stay tuned and we'll get right on that. All right. All right, traders, we are back. We are now looking at a naked chart. We're looking at the British pound Australian dollar. And let's take a look at some places where I have circled up on here. We could see that we have some of these candlestick formations that I was telling you about. And you could see that we had resistance up here. So let's start from top and work our way to the downside. So here, we see that we have this candlestick formation. Which one would y'all think this one is just by looking at it? You know, I'll give y'all a few seconds. I'll treat this like it's a door show and let y'all guess what this is. So what is this pattern? Right? It's a dark cloud cover. So when you look at this candlestick formation, we see right here, these two candles forms a dark cloud cover. So let's go ahead and write that in. Dark cloud cover. Right there. So we have a dark cloud cover right here. These two candlesticks, this purple one and this bearish blue one right here. So we see that this candle came back up to fractal levels. Resistance, formed a fractal here, confirming it's a resistance level. Then we see as momentum entered into this market for the bearish, for bears to enter this market. So how would you trade this? This is where you would put your entry and your stop loss. So your entry will be right below the low of that candlestick. You could put it right there, or you could put it put an entry right when that candle closes. So you would be entering right here. But me personally, I like to put it right here, just in case it does not go my way. So about 5 pips underneath the actual wick. So we could be a little more aggressive, maybe 2 pips, but right here it's about 7 pips, so that's about fine. So we'll take that. So we put our entry right here. Then we would have our stop loss either at the high or the open of the bearish candle or the high. So you can put your stop loss up here, have your stop loss at that point, and then let's see how many pips that is. All right, that's kind of a big stop loss. So if you don't want a big stop loss like that, you may want to consider, you know, changing your lot size, because this is the daily time frame. Having a 200 pip stop loss is okay as long as you use very good risk management and you're trading on a higher, and if you're trading a higher time frame, you're obviously going to want to use smaller lots. You're not going to want to use standards unless you have the account for that. If you do have the account for that, that's fine. So a standard lot is good, a micro lot's good, or you could put in multiple lots if you like. At the end of the day, it's about risk management. It's not about trying to make big, moves, using a lot of risk to make big profit. It's about using good risk management. So if you put your entry here, and let's say if you had like a $2,500 account and you're trading this, you're obviously not going to want to use a standard here. You're probably going to want to use micros or minis for this type of trade. Put in probably maybe a position or two, take this trade, and look, you got a good winning trade here. I'm not going to tell you how to take profit. This is not what this video is about. This is more for finding and identifying the candlestick formations and seeing how they worked. All right, so we saw if you had taken this trade and moved, quite, pretty far down. And if you had taken your profit at this level from where it is right there, you made a good 1,000 pips right there, 1,200 pips right there. So that's a good trade for this move, and even more if you went even lower. So if we look at the market here, you see how market was starting to get stagnant, move sideways. You see here that it formed a tweezer bottom here, but you see that the market failed to go higher. This is why I always tell you guys, if you're gonna trade a formation, it's not about it's not about how the market is going to, if the pattern's going to move in your favor or not. It's what it's all about is waiting and seeing if it's going to give you that confirmation to take that move. Here you see that the tweezer top failed right in here. So let's go ahead and move this down. Let's clone this actually, and let's drag this over here. So let's see. So we had a tweezer bottom here, which is a bullish reversal, but you see that the market kind of did go up, but it failed to break higher. So you see the market even went even lower. This is why I said you can't just rely on just price action or candlestick formations alone. There has to be something else behind it that makes you want to take the trade. So you have to realize here, we failed to break this high at this point. So if we were trading this, you could have traded this market this way, right there. Put your stop loss here, wait for it to trigger that. It never triggered. So after it did break higher, you see the market failed and went lower. So this was a weak trade right here. All right. Notice here, if you got in at this point, we had another dark cloud cover, pierced 50%, mainly really 70% of this candle, and you see the market went lower. All right. Here, now there's two ways you could have looked at this candlestick formation. All right, you could have looked at it as a 3 candlestick formation. This could have been that 3 candlestick pattern, or you could have looked at it individually as this candlestick, or this one. This was a hammer, and you see the market went higher. If you didn't trust that hammer, you could have waited for one more candle. You had a bullish engulfing, and you could have entered in on this candlestick, and you see you made profit. So you have to, this would have been a more aggressive way to take a more aggressive approach to take this trade, and you see what happened and went bullish. And this was not as aggressive, but it has more probability of you winning this trade because you waited and were patient, and you see what happened. It was a bullish engulfing candle, and you made profit going up. Right here, we had our evening star. All right, we had our evening star formation, and you see that 1, 2, 3 formation here. Market went lower. You made some profit here, but it wasn't a strong move. All right, it wasn't strong here. So there's some things that you have to really pay attention to the market. Like, have to understand market structure. If you look at this structure here, market didn't break this fractal level. It bounced off this fractal level here, and it held it. So you see how market came back to this level here, and then right here you could have got in on this trade here, a piercing candlestick formation. You could have made some profit there, but ultimately the market ended up ranging in here. So what ended up happening was this, a ranging market. All right. So when you see that the market was ranging in here, you have to pay attention to the price action at these tops and bottoms. This is where you want to get in your trade, at the top or at the bottom. Bullish engulfing candle, take it to the top, and you had a dark cloud cover, take that trade down, and then it ended up coming up a little bit higher. Here's another candlestick formation right in here, the tweezer top, and you see the market drop. So after you see the market drop here, then you have another piercing line formation. So we are assuming that the market's going to go up. All right, right in here. So notice how the market moves. You had different types of market structure. You had a bullish trend here, then you had a sideways market trending, and then we were waiting for the breakout. Then we get a breakout here, but it was false. So you could have actually extended this out a little bit more, and then look what happened. We had our real breakout right there, and then the market dropped. All right, so these candlestick formations help you identify market structure, how to get into the market before the move happens. Let's look at it with Ichimoku, see if we could catch anything. So with Ichimoku, The reason why I like using Ichimoku, it helps you identify and how to stay out of bad trades. On top of using it with price action, we know that this cloud is going to be used as a level of resistance here. So as price is going in here, we're thinking resistance, resistance, resistance until it breaks above the cloud. Now it did break above the cloud here, but notice what's happening here. We notice that the market is also in a consolidation phase. So we're not going to jump the gun here because we're still thinking bearish. All right. So when we look at this, we're still bearish. Get above, but look at that candlestick formation. And we had a break of the Kijun and Tinkinson here, and look what happened. Break of this range, market drops. So now when we look at this market, we're still thinking bearish, but what changes this concept, if you wanted to trade naked, we're thinking bullish because of price action. Why would we think to buy here? Because if we zoom out, go to our left, we see that we have to our left we have a level of support down here. We zoom over it, we see this is a level where buyers like to participate. All right, so we're thinking automatically buy. So let's see what candlestick formation we had here again. And when we look at this candlestick formation here, we see that we had a piercing line candlestick formation. Look at it, pierced at least 50% to 60% and more of this candle, which it did. So we're thinking bullish here. So a way that we could trade this, we could put our entry above this high right there, and we'll make this green for entry. And then we'll clone this real quick and put our stop loss here. So let's see how this goes. All right, let's see. So we play it. Would have hit our stop loss, but that's fine. So you could adjust your stop loss. You could have really put it here or at the bottom of this fractal. You should have it here. So let's say we did put it here for just educational purposes. So we are triggered here. Stop loss is there. We're in profit. And then now we have a long-legged doji right there. So we're thinking maybe consolidation, maybe a potential reversal here. So we want to wait. So if you want to get into something like this, what you could do, box this up just like this and wait for the market to give you an answer. Because if it breaks lower than this, we may want to short it. Breaks higher than this, we may want to go long. So let's see what happens. So here we're thinking short. All right. If you don't want to go short here, that's fine. Maybe you want to wait a little bit longer for more confirmation. Don't even bother entering this market here. All right. So let's see. Play it again. Market's still consolidating. So what this is telling us, this is now turning into spinning tops here. So now that we have spinning tops, now we could make our trading a little bit easier. Box this market in. And now you'll have a trade when you get the breakout. All right, so let's keep on playing it. Now we have a breakout above it. So now we're going to go long here. So now we could put our entry, our new entry right there, just slightly above. And let's put our stop loss right underneath our zone. Let's play it. Boom, in profit. So you have to understand how to read these candles and read these charts. And that was, boom, an easy 242 pips right there. All right. So you guys, that being said, this is how you read the charts with price candles and using support and resistance. You won't win every single time, but you have to understand that patience is what wins in this market, and also using very good risk management. That being said, God bless everybody that watched this video. Take care, and I will see you in the next. Peace.